everyone, welcome to a brand new show of Market Makers. Last 3 months have been quite stormy for global markets. We've seen a rout in emerging market currencies. China has been the center of gravity, and concerns have been raised about what will happen to global economy if China slows down further. But a famous investor once said that good news and good prices, they rarely come together. Right now, the news flow may not be all that encouraging, but our price is good. How should one capitalize in this current environment where in the short term there are abundant challenges? So to dissect that and to connect the dots, I have a very special guest, someone who you've seen before on Market Makers. That's Ravi Dharmishi of ValueQuest Investment Advisors. Ravi, fantastic to have you back. Thank you for joining us.
Thanks,
Nikunj. It's a difficult environment.
Surely. China is the big elephant, or rather the dragon. And as you said, it is the center of gravity right now. So if the dragon is going to stumble, there's going to be rumbling all around the world. So China has the potential to be the blackest of black swan. So no denying that. I won't say that this correction was unjustified or any such thing, or even I wouldn't even say that this is done and that's it, we are going to head towards a new high, something like that. See, China is, for the last 10 years or more than that, has been the biggest driver of the world GDP. It is the biggest consumer of commodities, and increasingly it's becoming more and more interconnected. It is the largest holder of US treasuries. So when China faces a problem, we are going to have a problem. There are dual impact for us as from India's point of view. One is the impact on the flows, the other is the impact on the economy. The impact on the flows we are already witnessing. There has been a global redemption wave across emerging market ETFs, and India is also bearing the brunt of that.
You're part of the same club.
You're part of the same club. It is impossible in today's interconnected world to not get impacted whenever there is a risk on, risk off kind of a global macro wave. So, but having said that, now the real impact on India's economy might not be all that bad. Metals or some trade sectors with China can possibly suffer, but well, we are a service economy and we are importing nation. We compete with China in attracting flows, in buying strategic assets, in buying raw materials. So if China has a problem, we have an advantage. This is our window of opportunity to build infrastructure, to buy raw materials at cheaper prices, to buy strategic assets worldwide. So I would say the net impact of China slowdown can only be positive for India.
So Buffett once said that volatility is a long-term investor's best friend. So is this volatility in the global markets a long-term investor's best friend?
I won't make a statement on the global markets. I would restrict myself to Indian markets, and from India's point of view, it definitely does look like an opportunity that is being, it's God sent. So I'll just to take a step back and I'll just explain a little bit more that any investor builds a narrative on what they are going to invest in. So the slogan that we all got used to was the Achhe Din. And the way equity markets are structured, it can only be either Achhe Din or not Achhe Din. If it goes up, then it's Achhe Din. It goes down, it's not Achhe Din. But in fact, now would actually be a good time. Now when people have lost that faith in, or the faith has reduced and have taken their bets off the table of economic revival, maybe this is a good time to bet on that economic revival. And I'm not saying, I still expect economic data points to be bad from a next 1-2 quarter point of view. But the much needed 50 bips repo rate cut has come. So, and we have some other triggers lined up. Government has front loaded the capex in railways and road and defense. So this is going to act as a stimulus to the economy, and we incrementally we are going to be on a much stronger wicket.
So trajectory for Indian economy is headed higher, which is very important. Interest rates are coming down, inflation is also coming down. But the 2008 experience has taught us one very crude and simple fact of life, that world is flat. There's nothing called decoupled. This word was coined in 2006 that India is indeed decoupled, but 2008 we learned that the hard way. So if China slows down further, if there is a chaos in global economy, which it could happen, what happens to India? I mean, on paper we are a great story, but question mark.
So decoupling is not like the world goes down the drain and will keep going up. But I'm actually enthused by the fact what we have witnessed in the last 4-5 months. The domestic flows have actually outpaced the FII outflow.
Very encouraging.
Which has cushioned the blow to a great extent. And this is the source of my bullishness more than anything else. I feel that the domestic flows have no choice but to come to equities or other financial instruments. So it's an encouraging sign. FIIs from time to time, we are in a global economy where we are crisis prone. So every few years we are surely going to get some crisis. And whenever that happens, the hot money that had flowed in will move out. And those are the times when one should be looking to pick up, so allocate more.
So never waste a crisis. You're of the view, and this is just like another crisis, but put your money to work. So let's talk about the level of correction.
Yeah, exactly. So I mean, you mentioned 2008. So that is something that I wanted to come to. I mean, 2008 is so fresh in everybody's mind that I don't think it can happen. See, 2008 was a time when the corporates were bullish. All their projections were bullish. They were investing based on those projections. The central bankers did not anticipate any kind of a crash. Investors were bullish, traders were bullish. Everybody was optimistic. That is not the case this time around. You need a combination of over optimism, seriously overvaluation, and over ownership for us to have a the kind of crash that we had, where the needle that is popping the bubble is unknown and it's going to lead to a domino effect. So the China can be that needle, but I feel at this point of time people are more scared by the enormity of problem in the China than we are not. This is the first time that equity markets are facing a China problem. So we have seen the impact of that, but it is not necessary that we will have the kind of downfall that we had in 2008, because the situation are just not the same. Everybody is cautious. Nobody is expanding their balance sheet. We are still in the mode where the balance sheets are getting contracted.
When Ravi Dharmeshi comes on the show, we talk less macro and we talk more sectors and trends. So let's talk about trends which you think have potential to outperform from here. It's an evolving world, and like the mantra of your firm is that look at individual stocks, don't look at macros, look at valuations, look at great businesses.
Absolutely. I mean, so this was one of my hesitance to do this show, because we are now restricting ourselves from talking stocks, and when a stock picker starts talking macros, you should be very careful. However, we
give me a flavor of what you're thinking and doing then.
So we try to have a sense of the market cycle, try to have a sense of the business cycle, rather than trying to act on it on a daily basis. So you do, regardless of your market view, the view is that unless these are like 2001 Nasdaq bubble or 2008 housing crash, unless those are the kind of situations, one should not be looking to take money out of the equity markets.
So are you fully invested?
We have stayed fully invested through this crisis, and to our pleasant surprise, portfolios are back to like kissing distance of new highs.
So markets are not at an all-time high. They are about 10-12% away from an all-time high. I'm looking at benchmark indices. Your portfolios are nearing there.
Absolutely. I mean, our portfolios are way above the benchmark indices. I mean, we don't benchmark ourselves to Nifty, but a broader market or a mid-cap market, or there are pockets where you can find alpha generating stories. So
let me give you a cue, and let me phrase my next question differently. What makes you bullish on consumption? What makes you bullish on branded plays? Why are you betting on that end of the market? If you can enumerate with an example, more like a global example, why are you bullish?
So there are two approaches. One is the process of elimination. You cannot be bullish on a lot of other spaces. So that is why we are bullish on this space, but I'll come to that a little bit more later on. Now, India is a service economy. India is a consuming economy. Most of the people feel that India's growth will come from infrastructure, but that's not what we believe in. India will remain a consuming economy, and once this $1.8 trillion economy with $1,500 per capita goes towards $4 trillion with closer to $3,000 kind of per capita, there will be a disproportionate rise in the disposable income, and there will be a disproportionate rise in the discretionary spending of the consumers. And our middle class is bigger than the entire population of America. So the the baby boomers, as they are called, there was a baby boomer generation in America, and we have like 5x that kind of a population that is going to get wealthy over the next 5-7 year period, and they are going to spend a lot on, they are going to consume a lot of things. So it has been and it will remain the overarching mega trend for us.
That's the core anchor of your portfolio.
Absolutely, absolutely. So there can be sub trends which can be going down. For example, 4-5 years back, we were very bullish on things that go inside a house, the building materials. Building material sector did not exist 5 years back. Now it has become a sector. So earlier maybe cement was the only thing that qualified under building material.
You've had some great investments there in the past.
Yes, we've had some fantastic winners over there. But so those were the derivative plays on real estate. Now the view is that real estate is going to face a lot of problem going forward. And I'm not talking about real estate stocks. I'm talking about the real estate sector. And if that is the case, then you cannot be betting on the derivatives on the real estate plays.
So no paint companies, no tile companies. You would generally advise our viewers not to look at any real estate ancillary. I
think they can become again a great opportunity maybe a couple of years down the line. I would say from at this point of time, they do not provide adequate return with a 2-3 year point of view.
Okay. Now let's look at the subsectors of consumption. The minute we say consumption, it's a very wide basket.
Absolutely.
And pretty much everything directly is consumption.
Yeah.
Starting from mobile data consumption to TV data consumption. What are the subsectors you like within consumption?
Yeah, you mentioned brand, and yeah, that's one thing that we are really bullish on. We have seen this happen in US. We have seen this happen in China. The factors are all there. We have a population, part of the population that is exposed to the Western culture. We consume, English entertainment, and we are aware of the logo brands.
So aspirational consumer is coming back. Aspiration is what you're betting on.
Aspiration has always been there. The affordability is there. Now availability is there. So, I mean, last week I was in Delhi, and the day one of the H&M store opening, and it was crazy. There was 700 people line to get into the store. A few months back there was the opening of Gap store, and the result, I mean, you can see there is a buzz. People want those logo brands. People want this is how they want to express themselves.
So you are bullish on textile companies which have local or global brands. Let me put it this way.
Yeah, I mean, of course you need to have, so even though you might be bullish on a particular theme, if you do not have a good enough business model, you might not invest in it. But the business model that we like in the space is definitely where you have your own a brand where pricing power can be exerted. And yeah, so that's the segment in the value chain that we are bullish on.
Again, within the branded players, there are two types of players. Companies which are selling global brands, companies which have their own brands. Without getting into specific, which one do you like? Companies which have own brands, which are local brands, or companies which are catering to global brands?
There is no reason for me to choose at this point of time.
So you have to bet on both?
Yes, both of them can do very well. There will be some homegrown brands that will become global one day, but I would say the global brands have an easier task of acceptability in the consumer.
Brands.
So they are well established, well known, and the task of selling that is easier. The Indian brands have a difficult task, but that doesn't mean that there cannot be winners over there as well.
The minute we think about consumption, the first thing which comes to everyone's mind is staples. FMCG, but you don't like FMCG or staples.
I won't say I don't like, but the current valuations do not give you a fantastic risk reward where you can generate outsized returns. However, I'm still holding on to some of my FMCG names which I bought earlier. I'm not going to sell out because it's going to have a 1 year, 2 year kind of an underperformance.
But do you think that consumer staple stocks have moved into a time-wise correction? HUL is nowhere close to a 52-week high. ITC is off from 400 to 315, 320. I can pick up more examples which will enumerate this point.
It's happening. It's happening. It's there for us to see. I mean, there might be an odd company that might continue doing well where there is still tailwind of margin expansion or growth. But as a sector, you're right. There is a time correction that is already in process.
What has differentiated your portfolio and basic investment from others is that you've been bullish on pharma and you've been right, and you continue to back that core thesis. I have a counterpoint now, something I may have not asked you a year ago. The regime is changing. And hear me out. US FDA is stringent. There is a price erosion in the US generic market. Domestic market is still flat. It is still growing in early teens. So with all these constraints, does it make sense to back some of these pharma companies which are richly valued?
Allow me a few minutes to explain.
On pharma, you can take all the
So
time.
in general, you might be right that there are some headwinds coming up. In fact, the price is not eroding. The problem is there is too much of price increase. So recently, Hillary Clinton made a statement on pharma drugs being priced over really highly priced, and since then biotech sector in US has seen a vicious correction. So there can be some pressures on the drug pricing in US going forward as we go into the election season. Having said that, pharma is not a homogeneous sector anymore. There can still be pockets that can continue to do well. The companies need to differentiate themselves by specializing more. If US FDA is issuing warnings to Sun Pharma, that is somebody else's opportunity. If it is issuing warning to Dr. Reddy, then it is somebody else's opportunity. So it is a double-edged sword. And in the long run, I believe what US FDA is doing will hold in good stead for the Indian pharma sector, because the distance between India and the rest of the world in pharmaceutical manufacturing will increase. We would have upgraded our standards of manufacturing, while China would not have.
Because we have skill and size.
Yes, this is a learning process. So every few years, US FDA does this. I mean, earlier they had come up with problems which were more manufacturing kind of a nature. Right now the problems are more related to the data integrity and all. So they are actually with their stick getting Indian pharmaceuticals manufacturer to upgrade themselves. So this in this there can be ups and downs, and there can be losers and winners, but that is where your opportunity. That does not take away from the fact that globally US generic market is about $50 billion, and Indians are taking away more and more market share of that.
We have less than 10% market share, I've been told.
Yeah. So yes, we have about 10% market share. So along with that headwind, there is one tailwind also. The approvals from US FDA's side have been really slow in the last 3-4 years.
So this is a glass half full approach
that is picking up now.
Yeah, in the last 1 month it has picked up.
In the last 3-4 months it has picked up, and all the pending approvals will start getting bunched up. The US FDA had implemented GDUFA norms about 2.5 years back, which are supposed to. So they have a mandate. They have a process in place. They have a mandate to approve a drug within 2 years, and there are certain drugs that have to be approved within 1 year. So the process is in place, and the effect of that starts taking place now. And companies, those who have the products and the filings, will benefit.
Do you believe that there will be a big reset in the Indian saving culture, and from hard asset money will move to financial assets?
It's already happening.
Mutual fund numbers are indicating that.
Yes, it is happening. So what has happened is since last 5-6 years, we actually had negative real interest rates. We were disincentivizing financial savings, and
because inflation was high and saving rates were low.
Correct.
Just to break it very simple for our viewers.
Correct. Yes, that's what it is. And now the inflation has come down and the savings rate is still high. So there is a positive differential of 1.5–2%, which RBI governor has said that he will maintain. Now, having said that, so there is an incentivization towards financial savings. And plus, on the other hand, there was overexposure to the real estate.
And gold.
So I was reading some article yesterday where over the last 10-year period, India has imported more gold than the total money that FIIs and DIIs have put in the equity market.
That's a lovely article.
That's so much of unproductive use of capital.
That is going to reverse according to you.
Absolutely.
So let's imagine that if the savings, they really go through this reset button which they are going through. As a stock market investor, how should one participate? Do you buy exchanges? Do you buy banks which have AMCs? Do you buy companies which are pure vanilla brokerages?
Yeah, so all those that you mentioned. So
buy the entire supply chain.
All of them are the beneficiaries. I won't say buy the entire supply chain. You have to figure out which are the business models that are likely to sustain. Because everything said and done, there's a huge disruptive wave also, the technological disruption that is happening. And it is not very clear which business models will survive, which companies will be able to migrate to a better technology regime. And so one great investor has said that if the rate of change within your business is slower than the rate of change outside of your business, then you will die. So you need to be faster to change than what the environment that is changing.
Of course, technology, digital, everything is changing.
So having put that caveat in, I feel yes, the financial savings are going to explode and there will be beneficiaries all across. But you need to pick and choose your business models. Where
are you picking and choosing?
I think exchanges are definitely one where it's a fantastic business model and they can benefit greatly. And I don't see major threat yet to that model.
Since we are discussing lovely quotations, one lovely quotation is that you should always buy fear and sell greed. There is outright fear in metals and commodities. Some of these stocks have gone way below their book. Hindalco, I think, is nearing half the time book. As a value investor, are you tempted to look at that space? You may not make money in 3 months, you may not make money in 6 months, but when the cycle reverses, you could end up hitting multi-baggers.
I actually have an opposite view. You might make money in 3 months and 6 months because they have gotten so expensive, but it would be very difficult to generate outsized return over a 3–4 year period if we believe that China has just begun its downward spiral.
So metals are a good trading opportunity, but lousy investments. What else is a lousy investment in this market?
Earlier I mentioned
that's a very small sector. Housing ancillary is very small.
Capex cycle.
Capex cycle. Okay. Let's discuss that extensively.
PSU banks.
So when you say capex cycles, you are of the view that one should not buy into cyclicals. One should not buy into companies which will be reviving the economic growth. If you're bullish on the economic revival, shouldn't you be bullish on them?
It's not going to be the PSU banks that are going to play that role. It's going to be the private banks. The 10-year trend is going to be that private banks will take away more and more market share from the PSU banks, and PSU banks do not realize the kind of risk that they are facing from the technology.
Yeah.
So
technology,
having said that,
culture,
that doesn't mean it cannot generate fantastic trading returns from a 1–2 year point of view.
As an investor, are you not excited and happy about the new government plan, Indradhanush?
No, I am not so excited that I'll go and bet on the PSU banks, because I believe it's an incremental step, and there is all the time there's a hanging sword of the capital that is needed. It's about 4.2 lakh crores needed over the next 4 to 5 year period. There is going to be constant dilutions.
I would have loved to get into a stock specific conversation, but I respect the compliance. But thank you for your time.
Thanks, Nikunj.
Thank you for your lovely insights.
Thank you so much.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. That was Ravi Dharmishi of ValueQuest Investment Advisors.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.